Working with tripartite financing agreements. Access to finance for smallholder farmers remains a major challenge in agricultural development. Smallholders are underserved by traditional finance due to financial service providers like banks that are hesitant to engage. But why? Here are 3 key reasons. High transaction costs of customer acquisition and loan administration, lack of data to understand creditworthiness, and limited collateral to reduce repayment risk. In the absence of traditional finance, agribusinesses often step in. However, they lend mainly out of necessity rather than choice. Such agribusinesses often lack the resources and experience to manage and administer loans. On top of that, they use up their working capital for lending rather than core business, and occasionally take a loss from lax lending standards. Tripartite financing agreements, arrangements between a financial institution, an off-taker, farmers, and often an input provider, have the potential to solve many of the cost and risk considerations that have deterred actors from lending to smallholders. But how does this work? First, an off-take agreement is made between the farmers and an off-taker. This serves as collateral for the bank. After approval, the bank advances loan funds to the farmer or directly to the input provider. If the farmer receives funds in cash, they will purchase inputs. If the loan goes to the input provider, the farmer receives inputs worth the value of the loan. After harvest, the farmer sells their produce to the off-taker. The loan amount is deducted from the proceeds by the off-taker. The loan amount is then transferred directly back to the bank. IDH is supporting several partners in establishing tripartite financing agreements, and here are key learnings from the process. 1. Leave ample time for negotiations. Be prepared that aligning on key terms, such as collateral requirements, eligibility criteria, and interest rate, can drag. 2. Ensure that farmers are well prepared to receive loans. Invest in financial literacy training and avoid over-indebting farmers. 3. Decide whether to offer group loans or individual loans. Group loans can be a lower risk and are easier to administer. 4. Agree on responsibilities. Determine who will support farmers, from loan application to recovery. 5. Use in-kind loan and repayment structures. Giving inputs over cash encourages proper use, while taking repayment directly from produce sales streamlines recovery. 6. Consider additional risk mitigation. Add insurance or decide if there are additional collateral needs. However, remember that additional collateral, like land title, can be restrictive to women and youth. IDH, transforming markets.